You take those moving averages. Do you look at the moving averages, or do you give caution by a non-farm statistic of 103 and a 2-month payroll revision of -50? Is it a 53,000 month lousy, or is it a better report than that?
Well, it's lousy, and I do look at moving averages, too many to tell you the truth, 200 day and several years in many cases. But yeah, I think this is a weakish type of report. It's true that, and I would have said going in, that wages were the key consideration. 0.3 was what was expected over a 0.1 last month, so that averages out 0.2 and 2.7 on an annual basis, which isn't much change. And so, you know, I would think this makes for a more cautious Fed, especially in light of the global trade situation that we see on an overnight basis. We're just going to have to see, but I think the Fed will be cautious going forward. My forecast has always been for a 1 or 2 hike 2018 type of year.
Bill Gross, if we got wage growth, as John Farrell mentioned, spot on, you've got to take inflation out of that to get to real or inflation-adjusted wage growth. Do we have inflation-adjusted wage growth?
Well, I don't think we have much, and I've got an interesting chart in front of me. You can't show it, but it starts in the 1980s. It looks
good. Oh, Bill, it looks so good on radio. That chart on radio is gorgeous. Bill, continue.
Well, let's talk about it then. Since 1980, real wages have flatlined. It's almost like this patient is dead, and real output has basically doubled. And so where has that productivity gone to? It certainly hasn't gone to wages. It's gone to corporations, and that's good for stocks, I suppose, in terms of earnings. But if the Fed's goal basically is to get wages up and to get that inflation rate at 2% or more, I don't think they're really doing much of a job.
Bill, I want to talk about how you're positioned. You've talked about this short that you've got in high yield over the last couple of months with us on Bloomberg Radio and on Bloomberg TV. It's a short that seems to be struggling to pay off. We've had risk appetite take a real hit over the last couple of months, but all the volatility, all the downside seems to be in equities, and high yield seems to be where the relative outperformance is in risk assets. Can you explain why you think that is, Bill?
Yeah, high yield's doing okay. You know, high yield tends to, in terms of volatility, say the VIX is 20. High yield tends to have a VIX-related volatility of about 5, you know, about a quarter of what the stock market does. And, you know, it's a slower-moving type of average. And investors wait on high yield to see, you know, the expected number of defaults going forward. And so far, they've been relatively benign, Jonathan. And so I think that's the main point. What I do say, in addition to that, and the things that are making the short work out over the past month or so, is that you know, the global trade situation and the potential, you know, economic problems that higher interest rates, you know, place on low quality corporate credits, you know, eventually forces those spreads a little wider, and that's basically what the bet's about.
I guess what I'm trying to ask, Bill, is that is there a more optimal way of expressing this sort of hit against risk appetite away from credit in, say, equities, where the volatility seems to be contained and isolated right now?
Well, volatility may be contained, I guess. It's hard for me to make that description. But I think what I'm doing in high yield, it's a little sophisticated, but basically I'm selling calls and selling puts on the HYCDX, which is the, you know, the benchmark for the high yield market. And to the extent that it doesn't move by more than 50 basis points one way or the other over a month's period of time, then you capture the premium. So I'm expecting high yield to gradually move higher, but if it doesn't significantly move lower, then the bet pays off.
Bill Gross with us of Janus Henderson on Bloomberg Television and Bloomberg Radio this morning. Bill, I do want to turn to the politics and fold it into your decades of work in financial theory and economic theory. I'm going to cut to the chase that you're, my guess, a critic of what the president's saying and maybe even doing. What does the president most get wrong?
Well, he gets the trade deficit wrong. I mean, the trade deficit, as most economists would affirm, as a result of overconsumption and undersaving on the part of the United States. Our savings ratio is down to 2%, which is historically low. The trade deficit at 3% plus of GDP is, basically relatively high. And to the extent that we like to buy things and not save, then we're going to have a trade deficit because we buy things here in the United States, and then when we can't buy enough, we buy it overseas. And so Trump basically has it wrong. It doesn't mean that we're not being gamed by some countries in terms of, tariffs or in terms of technology or cheaper goods and services, but it does mean that there's little way to change this situation by imposing tariffs on foreign goods and services.
So then what do you need from Larry Kudlow? Mr. Kudlow is going to join John Farrow here in about, I'm guessing, 45 minutes, maybe it's 35 minutes. I'm serious, Bill. What does Lawrence Kudlow and other free traders, even Secretary Ross, what do they need to do to stop the discourse that has a political tinge? I understand that. We all understand the president's angle on that, but its effect on China. What does Kudlow need to do to jumpstart that process this weekend?
Well, he needs to calm the verbal tweeting down, so to speak. He needs to basically acknowledge that Trump is a negotiator and that part of the process of negotiation is to go to extremes like he did last night with $100 billion more. The question that the markets have to ascertain is whether or not, there's a semblance of truth to that and whether or not there might be $100 billion behind that. And so, I think in the equity markets that there are risk premiums, as you know, and that, this continued type of verbalization and tweeting on the part of trade, not only tweeting, but real tariffs being imposed, basically raises the equity premium by a 0.5% or so relative to what it is. Say it's a 4 to 5% premium, it raises it by 0.5%. And what does that do to prices? It lowers it by about 3 or 4% in terms of the stock market.